What's happening, crypto enthusiasts? Get ready for a rapid-fire update that's going to blow your mind. The crypto world never sleeps, and neither do we. We're diving headfirst into the most electrifying developments that are shaping the future right now. You absolutely do not want to miss what's coming up. We've got insights that could redefine your entire strategy. So buckle up, because the pace is picking up and the stakes are higher than ever. Are you ready to catch the next wave? We're breaking down the news that matters, the stories that are making the biggest impact, and the predictions that have everyone talking. Our first story comes from a very familiar name in the political arena, with a surprising endorsement for the digital asset space. Next up, we're looking at the sheer scale of investment pouring into digital asset funds. We're talking about trillions, folks, and a bold question is being asked. Could these funds be on the verge of challenging gold itself as the ultimate safe haven asset? The numbers are staggering, and the implications are massive. Then, we're diving deep into market analysis with a crucial warning from a key indicator. Could the current bull market be heading for an early exit? While some signals suggest caution, other market flows are painting a decidedly bullish picture. We'll break down what this means for your portfolio. And finally, we're exploring a strategy that's gaining traction in the options market, designed for a specific kind of market environment. Is this the smart play when volatility is low, but the potential for big moves is always lurking? We've got the expert take. Stick around, because this is your essential briefing. Hit that like button, smash subscribe, and ring that notification bell so you don't miss a single second of the action. Political figure endorses digital assets. In a surprising turn of events, a prominent figure from the political landscape has publicly declared a strong affinity for the burgeoning digital asset community. Eric Trump, son of former U.S. President Donald Trump, recently shared his family's love and belief in the Bitcoin ecosystem, a community that notably rallied behind his father during his presidential campaigns. This endorsement comes at a significant moment, highlighting a growing intersection between traditional politics and the decentralized finance world. Speaking at the prestigious Bitcoin Asia conference held in Hong Kong, Eric Trump didn't just express a passive appreciation. He went on to make a bold prediction about the future valuation of Bitcoin. He confidently stated his belief that the flagship cryptocurrency could reach an astounding $1 million valuation. This forward-looking statement from a member of a well-known political family is likely to resonate widely within the crypto space and beyond, potentially influencing public perception and investor sentiment. The context of this announcement at a major international conference underscores the increasing legitimacy and global reach of digital currencies. Bitcoin Asia serves as a critical hub for industry leaders, innovators, and investors, making it a high-profile platform for such declarations. Trump's presence and pronouncements suggest a growing acknowledgement of Bitcoin's potential impact on global finance and a willingness from influential figures to engage with and champion the technology. This sentiment from the Trump family could be interpreted in various ways. It might signal a potential shift in how political figures view and interact with cryptocurrencies, moving from skepticism to active support. The mention of the community's support during his father's presidency also draws a parallel between political capital and the decentralized movement, suggesting an understanding of grassroots support systems. Furthermore, the $1 million price prediction, while ambitious, aligns with the optimistic outlook held by many long-term Bitcoin proponents who see its potential as a store of value and a revolutionary financial technology. The implications of such high-profile endorsements are significant. They can attract new investors, encourage regulatory bodies to engage more constructively with the industry, and generally boost confidence in the digital asset market. As Bitcoin continues to mature and integrate into the broader financial system, these endorsements from unexpected quarters add another layer to its complex narrative. But is this optimism reflected in all market signals? Stay tuned as we examine a critical indicator that might be flashing a warning sign for the current bull run. Digital asset funds skyrocket, challenging gold's safe haven status. In a remarkable display of investor confidence and market evolution, digital asset funds have experienced an unprecedented surge in assets under management, AUM, throughout 2025. Reports indicate that these funds have collectively climbed to a staggering $162 billion, signaling a seismic shift in how investors perceive and allocate capital towards digital assets. This dramatic increase in AUM is not merely a statistical anomaly. It represents a fundamental reevaluation of Bitcoin and other cryptocurrencies as viable investment vehicles, capable of rivaling traditional safe haven assets. The context for this surge is a market increasingly seeking alternatives to traditional financial instruments, driven by global economic uncertainties, inflation concerns, and a growing digital native investor base. As institutional adoption accelerates and regulatory clarity improves in various jurisdictions, the appeal of digital assets as a store of value and a hedge against economic volatility has intensified. The sheer volume of capital flowing into these funds suggests a strong conviction among investors that the digital asset class offers significant long-term growth potential and diversification benefits. This substantial growth in AUM positions digital asset funds to potentially challenge gold, an asset historically revered as the ultimate safe haven. For centuries, gold has been the go-to asset during times of economic turmoil, offering stability and preserving wealth. However, the digital revolution has introduced a new contender. The inherent scarcity, decentralized nature, and increasing adoption of Bitcoin, in particular, are being cited by proponents as characteristics that could supersede gold's traditional role. The ability to hold, transfer, and access Bitcoin digitally, coupled with its growing network effects, presents a compelling case for its adoption as a modern-day safe haven. The $162 billion figure reflects not only the price appreciation of underlying digital assets, but also the net new capital inflows driven by products like spot Bitcoin ETFs, which have opened the doors for broader market participation. These products have democratized access, allowing a wider range of investors to gain exposure to Bitcoin without the complexities of direct ownership. The success of these financial instruments is a testament to the market's readiness for regulated and accessible digital asset investment opportunities. Analysts are closely watching this trend, debating whether digital assets can truly usurp gold's long-held position. While gold offers a tangible, physical asset with a deep history, Bitcoin offers digital scarcity and a global, permissionless network. The debate often centers on volatility, perceived risk, and the long-term stability of each asset class. However, the sheer momentum behind digital asset funds suggests that a significant portion of the market is betting on the digital future, viewing Bitcoin and its ecosystem as the next evolution in wealth preservation and growth. While the inflows are undeniably bullish, not all indicators are pointing in the same direction. We'll now analyze a key metric that's warning of a potential shift in the market's trajectory. Key indicator warns of early Bitcoin bull market end amidst conflicting flows. A critical technical indicator is sending a cautionary signal, suggesting that the current Bitcoin bull market might be heading towards a premature conclusion. This warning comes even as market participants continue to position themselves for sustained rallies through the remainder of the year. The divergence between technical signals and market sentiment creates a complex picture for investors navigating the volatile digital asset landscape. The indicator in focus is the Relative Strength Index, RSI, a widely used momentum oscillator that gauges the speed and magnitude of price changes. Typically calculated over 14-day, 14-week, or 14-month periods, the RSI fluctuates between 0 and 100, with readings above 70 often indicating overbought conditions and readings below 30 suggesting oversold territory. However, its more nuanced application lies in identifying divergences, which can signal potential trend reversals. Specifically, Bitcoin's 14-month RSI is currently exhibiting a bearish divergence. This occurs when the price of an asset makes higher highs, while the RSI simultaneously makes lower highs. On the monthly chart, this pattern has emerged as Bitcoin surpassed its previous peaks from December 2017 and November 2021 during the July-August period. Despite the price making new highs, the RSI failed to confirm this momentum, instead forming a lower high. This technical anomaly suggests that the underlying strength supporting the price rally may be weakening, potentially foreshadowing a trend reversal. Adding further weight to this bearish divergence is its confluence with significant resistance levels. Bitcoin is currently encountering a key trendline that connects the previous bull market peaks established in December 2017 and November 2021. Breaking through such resistance levels is crucial for sustaining an uptrend, and failure to do so, especially when coupled with a bearish divergence on a long-term timeframe, increases the probability of a pullback or a more substantial correction. However, the narrative isn't entirely bearish. Despite the technical warning signs, recent market flows indicate that traders are actively preparing for continued price appreciation. Data from block trades, which represent large, privately negotiated transactions often involving institutional players and high-net-worth individuals, suggest a bullish leaning. For instance, notable activity in December Bitcoin call spreads, specifically targeting the $125,000 and $160,000 strike prices, indicates that sophisticated traders are betting on significant upside potential by year-end. This dichotomy, bearish technical signals versus bullish on-chain and options activity, presents a classic market dilemma. While the RSI and trendline resistance suggest caution, the positioning of major market players implies an expectation of further gains, with some forecasts even projecting Bitcoin to reach $190,000. As of the latest data, Bitcoin was trading near $110,500, showing a slight monthly decline, but the overall sentiment among active traders remains optimistic. With these mixed signals, how should traders position themselves? We'll now look at a specific options strategy being recommended for the current market environment. Bitcoin Options Strategy, the short strangle for near-term calm. Bitcoin has recently defied expectations for significant price volatility, largely trading within a defined range throughout August. In response to this market dynamic, a particular options strategy, known as the short strangle, is being highlighted by analysts as an ideal play for the anticipated near-term low volatility environment. This strategy aims to capitalize on the lack of substantial price movement. Marcus Thielen, founder of 10x Research, outlined the rationale behind recommending the short strangle for the upcoming month. With Bitcoin hovering around the $113,000 mark and market expectations pointing towards a continued range between $95,000 and $125,000, selling out-of-the-money OTM options presents a lucrative opportunity. Specifically, the strategy involves simultaneously selling an OTM put option with a strike price near $95,000 and an OTM call option with a strike price near $125,000, both with the same September expiry date. The objective is to collect the premium from selling these options. A short strangle is a strategy where a trader sells both a higher strike call and a lower strike put, both out of the money, with the same expiration date. Essentially, it's akin to selling insurance against both upward and downward price movements beyond the specified strike prices. The maximum profit is realized if the price of the underlying asset, in this case, Bitcoin, remains between the two strike prices at expiration. The premium received from selling these options constitutes the profit. This strategy typically thrives when implied volatility, IV, is higher than realized volatility. Implied volatility reflects the market's expectation of future price swings, while realized volatility measures the actual price movements that have occurred. When IV is elevated relative to realized volatility, it suggests that options are relatively overpriced, and the market anticipates larger moves than are actually materializing. Selling these overpriced options allows traders to capture this premium, profiting from the time decay and the expectation of stability. Thielen elaborated that the current implied volatility term structure indicates a period of near-term calm. The term structure visually represents how expected volatility changes over different time horizons. An upward-sloping curve typically signifies increasing uncertainty further out in time, but the current near-term structure suggests a plateau or even a slight decline in expected volatility for the immediate future. This environment is precisely what makes selling options, like those in a short strangle, attractive. For the short strangle strategy to be profitable, Bitcoin must indeed stay within the $95,000 to $125,000 range until the September expiry. If Bitcoin experiences significant price swings outside this band, the strategy could incur substantial losses, as the seller would be obligated to cover the difference. The range-bound trading helps to drain the extrinsic value, time value, from the OTM options, benefiting the seller. It's worth noting that Thielen had previously recommended a similar short strangle in early August, which involved selling a $105,000 put and a $130,000 call. That particular strategy reportedly yielded a 3.5% return. However, it is crucial for traders to understand that selling options, particularly strategies like the short strangle, carries significant risks. A sudden and sharp increase in volatility could lead to substantial, potentially unlimited losses on the call side if not managed properly. Therefore, continuous monitoring of the position and market conditions is paramount for effective risk management. We've covered a lot of ground today, from political endorsements to market indicators and trading strategies. Let's quickly recap the key takeaways before we wrap up. And that's a wrap on today's essential updates. We saw a major political endorsement for Bitcoin, a massive surge in digital asset fund AUM potentially challenging gold, a key indicator warning of a possible bull market slowdown, and a deep dive into the short strangle options strategy for comm markets. Don't forget to smash that like button if you found this valuable, subscribe for more cutting-edge crypto news, and ring that notification bell to stay ahead of the curve. Connect with us on all social media platforms to join the conversation and share your thoughts. We'll see you in the next one.